Good afternoon, good evening, good morning, depending on when you're watching this video. Welcome. If you're a first-time listener, watcher, and so forth, viewer rather, please don't forget to subscribe, like, and share this video. It's me, your host, Kat, today, not alone. I'm still joined by the gentleman from Thousand Capital, aka T1C. So I'm going to let the gentlemen introduce themselves before we delve into the topic today, starting with the gentleman on my left.
Hi guys, I'm Jabulo Tele.
All right, and the gentleman on my right? All right. So gentlemen, you both are from Thousand Capital, and today we'll be discussing the equity that Thousand Capital would be investing in on behalf of its shareholders or investors rather. So before we go into that, what are equities for most people who don't know what is an equity and what is not an equity stock?
All right. So an equity is a line of capital that says that I'm going to get everything else that's left in the business. Right. Some people say that's the most riskiest. Yes. We believe if you do your homework, that's the best position to be in. You pay everybody first, and then you get what's left.
Okay. All right. So then, how then do I decide which equity stock to buy in, and how does Thousand Capital decide on that?
Thanks for that clarity. Actually, you're saying how do I don't decide, buy an ETF, and I think that's very important to say that if you're a beginner, buy an ETF, get a professional, give them your money, preferably a once-off fixed fee, and then let them run you through it, and then use that knowledge to then, as I say, still buy an ETF. But if you're asking about T1C and why we're not buying ETFs, ETFs are good if you want to match the market.
Can I just stop you there, but what are ETFs? Problem. What does ETF represent?
ETF, I think we're on the wrong show for this. It's exchange-traded funds. Right. So basically it's a basket of shares.
All right, okay. Sorry, you can continue.
No, not a hassle, don't worry. So with us, essentially, so with ETFs, you're matching the market, and that's good enough for almost anybody.
Yes.
The moment you want to beat the market or outdo the market, then you would go into selecting your own shares.
All right.
Right? Now, what gives us the confidence that we can beat the market? Well, firstly, the fact that we acknowledge that it's impossible to beat the market. I think that's our first competitive edge.
Okay.
How do we then go on to choose our shares, knowing that we can't beat our market? Okay. We limit our decision making. Okay. We buy once in a long while. So for the most part, I think we've been at this for the past 7-8 years. Yeah. Okay. We've just been doing research. Obviously, we buy some shares on the side to test if our research is working. But when I say research, I mean you go back to the 1900s with the man himself, Benjamin Graham. I know most people would have thought Warren Buffett. Yes. And his teacher. He's also our teacher. So we're one of the lucky people that don't learn from Buffett. We learn from the teacher himself. Okay. And you can go even further back to the Dutch East India Company in the 1400s that actually introduced the concept of companies and incorporating in equity-like structures. To answer your question, how do we select our shares? Yes. Right? We want companies that don't have debt. If you don't have debt, you can't go out of business. Okay. It's that simple. If you don't owe anybody money, nothing's going to take you out of business. Okay. Then the moment you have that position, you must be positive. You must be earning positive. You must have positive earnings, right? So now you're in the fantastic position where you don't owe anybody anything. Mm-hmm. You can just stand there and we'll find you again there next year. Mm-hmm. But you're actually doing something. You actually decide, let me just start waving at people. Mm-hmm. Contributing to society, they pay you, and then you're making an earnings. And a very important criteria for us, because we're not fans, we're not watching football, so we're not just looking for good companies that are earning an income. Yes. We want that income in our bank pocket. Okay. So the last criteria that we're very strict about is we want a company that pays out dividends. Okay. So we've got a fantastic situation where you have a company that owes nobody money, is making more money, and is paying it back to shareholders. Okay. That's how we select our companies.
All right. So you mentioned something about companies that don't have any debt and that pay out dividends. Now, realistically speaking, if we're talking about the JSE, I mean, that sounds like quite a niche market. How many companies like that exist? And would you not say that's a rather conservative approach in terms of even the value that I would see, or in terms of the appreciation, for example, on that particular share in 5 years' time or 10 years' time?
At any point, Charlie can jump in.
I'd love to actually, yeah.
The spreadsheet guy.
I've been enjoying this interaction between you two. So essentially, just to go back to your question, Kat, the reason why we say debt-free and we say we don't want companies that owe people money is for the sole purpose of capital preservation, in the sense that if you don't owe anyone, you can't go bankrupt. As soon as you start taking on debt, we've seen amazing companies literally get crippled by debt.
Sasol, if you're
for
phrased to
instance,
name some.
just we saw what happened this past week. With Sasol, Tongat, EOH. There's so many. The list goes on and on and on, and not just locally, abroad as well. So we know that debt is one of the major contributors towards companies crippling. And now, being in T1C, we're in this position where we want our capital to grow and to be protected at the same time, So if we don't have any debt on our books, then we definitely know that we're not going to lose any money, first, for starters. And then to go on to the third criteria that Chairman Mo mentioned, is that they're going to be paying us dividends. So we're going to be generating a return, And essentially that's what we want, cash generating companies that have no debt.
And not that there's much to add to what Jack said. If you are holding Sasol, for example, that was at 600 at some point, or you're holding Naspers or Capitec or whatnot, it means you haven't sold it. So when a week like last week happens, that return that you had has disappeared this week. Whereas if we're holding for dividends, we've been getting our return. And when a week like last week happens, you open my portfolio, if there's a share that's 50% down, I've already got the money in my pocket. So what has happened to you has happened to me, except I've been getting paid in the process.
But to be fair, your Naspers, your Sasol, they also pay dividends. So we all have, and they're known to pay huge dividends. So as well, so I've also gotten the return in actual sense, because the depreciation of a value of a share, a return is not a return unless it's in your pocket. That's just artificial money and so forth. So in terms of return, we both have received.
And I like that you said, to be fair, and I'd ask you for your numbers when you say they pay huge dividends. You pay 2,000 Rand for a Naspers share and you get a 2 Rand 50 dividend. I think the dividend has topped 20 Rand in the past. That's the highest dividend that they've paid in their history. I mean, you do the maths, 20 Rand out of 2,000 Rand. Compared to a company, for example, like Louis that we're fans of, it pays you a 2 Rand dividend, but you're paying 25 Rand for the share. That's what.
So I think that's a bit of semantics depending on when you bought the share. Because if I bought the share, when was it? Like, for example, 2,000 Rands. But that's semantics that I don't want us to get into for this particular conversation. So I just want to know, because you mentioned conservative funds. You mentioned that the companies with no debt. To my earlier questions, how many of those companies exist in SA? Because I need to know then, like, you're saying you guys want to invest in companies that don't have any bad credit and so forth. So then how many of those exist and they pay a dividend?
It's actually a really great question, actually. So what we've been doing for the past 7-8 years is that we've been looking at all the companies in the JSE. Literally every single company. We've even extended it to the alt exit certain times. But then for the purposes of this conversation, it's obviously centered around the JSE. So when you talk about companies with no debt, there are companies in the JSE that do not have any debt.
I think we found about 8 with absolutely no debt and about 59 with low enough debt that they can pay it off 10 times in the next year.
Which is essentially what we
cash.
want. With cash that they currently have on their books.
So are any of them top 40 shares or?
Kumba. Also.
Also. What else? Mr. Price. They're top 40.
Mr. Price, it's low debt, very cash generative, but not absolutely no debt.
There is a bit of debt.
So 3 out of the top 40, that's where your pension fund is.
So just to also give our viewers perspective in terms of what he was talking about, in terms of what happened this week into the financial stock markets, it was a very, very terrible week globally and locally.
For some.
And we're actually going to inquire why he says for some. Maybe he was one of the lucky few there. So, so obviously the whole corona outbreak and it was classified as a pandemic and so forth.
Yeah.
That's so obviously the stocks crumbled. But it was just not only this week, it was actually since the beginning of February, pretty much. The stocks have been on a decline as a result of that. So I'll ask you, you say for some, who are the lucky few? Are you the lucky few? Why are you the lucky few?
Buffett is sitting on 178 billion, so it was an interesting week for him.
Okay.
But for anybody else that follows anybody that might be linked to Buffett's philosophy, and obviously that scopes us in. I mean, if you're sitting for a good 7-8 years, so I mean, Corona and oil price dropping this week.
Yes.
Imagine a week where they announce Brexit, Trump wins the presidential election, and China decides that they're going to unpeg their currency against the dollar.
Yes.
That's when we started investing. So you can imagine that this week, in terms of impact, it's had a bigger impact than what we've seen before.
Yes.
But in terms of controversial news that can come out, I think we've seen a bit worse. So in situations like that, over the last 5 to 7 years, we've been in a position where we're doing this research, we are aware of these companies, some of them are out of our reach, as you mentioned, Mr. Price.
Yes.
And then a week like this happens. It's like finding out that there's a sale at your favorite shop, and that jersey that you knew you can't afford finally goes on sale.
Yeah.
So in a week like that, where everybody's selling, we happen to be buying.
Okay. So with that said, then obviously, as you know, the financial markets repeat themselves. So if I'm now going to T1C, right, there's a huge possibility 5 years, in those shares that you guys would have invested, the very same thing will happen. What are the measures that you guys are implementing in terms of the exposure or impact to minimize that? Because you buying now when it's low, best believe it's been recorded in almost every 10 years there's a sort of global recession that happens. So
and that's why, for example, if you're getting 12, 15, 17% of your money back, doesn't take an idiot to figure out that by year 7 you have your money back. So market crash has got 3 years. You have a 3-year buffer before the next market crash, and we're talking cash. So you still have your capital in that company that you can still get back, and you've gotten 100% of your money back through dividends.
So this all sounds very well and so forth. It sounds like there's huge returns, but I've also, as a general viewer, I've also had like skepticism about equities. Like it's a fugazi, as it's called in a popular Wall Street movie as well. And I mean, I think also that also would make one less likely to invest in them, because you saw the corruption or whatever that's also involved in that. Because who are these people that literally determine this price? What determines the price of a share and so forth? And and impact on political interference, so to say. Who has control over that? And
and I think that's why we then realized an obvious edge. If the stock market price is determined by so many factors that are not finance related, right? And we can isolate the one thing that hits the bank account, then at least we can focus on that. And then when it comes to who took the price down, who takes the price up, that is somebody else's area of expertise. And what protects us against that is the fact that worst case scenario, a scandal comes out, one of the CEOs that we invested in is involved in money laundering. Company's price tanks. We're not buying for share price, we're buying for dividends. The company doesn't have any debts. It's going to be uncomfortable to see your company is 80% down, but they don't owe anybody money. It's a matter of them trading another year, more money comes into the company, they declare dividend, they pay it back to us.
All right. So then, are you, any of you gentlemen, currently or professionally, you have professional experience in those particular fields, or is it just personal experience you have in terms of equities?
In terms of that, again, you'd want either have to define that. But if you're talking about licensing, FSP, whatnot, I'm currently doing my FSP license. But that's very important. Why it's important is because that speaks to my ability to give financial advice. So one thing you'll never find me doing is on a platform giving people financial advice. You won't find me selling a financial product to anybody. But what it does not do is give me a methodology for investing in equities.
Okay.
Yeah.
Okay.
Yeah. And essentially, determining that methodology for us is one of the most critical things.
Yeah.
You know, low debt, positive earnings, and
Okay. And I think to what Jax is saying, we both like Sasso very much, but we can never buy it for thousands because it will never ever meet the criteria that we have.
Yeah.
So in our personal portfolios, we might speculate on it, but for thousands, there's absolutely no way we can think of getting near any company with as much debt as Sasso has.
Yeah.
Okay. Yeah. Okay. So then, in terms of equities that you're investing in, is it locally, internationally as well? And how do you determine that exposure? Like a 30% must be local and so forth. And also, in terms of let's start there. Then we'll narrow it down in terms of also the specific sectors as well.
And I'm lucky for that. We have our spreadsheet king. It's the JSE because that's where we have the most information. We live in it. We have the most exposure to it. But in terms of capital allocations and percentages and all of that sort of thing, Jax will speak to it. We have a brilliant spreadsheet for that.
So we've determined a pretty comprehensive spreadsheet, which, or depending on how comfortable the other shareholders feel, we can actually share. So essentially, we've actually capped the number of stocks that we'd like to invest to about 30 companies, which we believe that is actually gives us a nice pool.
And mind you, we have how many? We have 60. If you mentioned 59 with relative debt, 8 with no debt. There's 67 companies we can invest in, and we've said we're not that smart. We're limited to 30 companies.
So we essentially picked the best 30 that we believe are the best 30. And there's a number of calculations that we've actually done, and we looked at the financial statements and done a lot of ratios to actually determine the top 30. So in terms of allocation, the majority of it is all in the JSE actually. It's actually just all in the JSE. It's just 30 companies, local companies. And then in terms of allocation, we've actually, at this point in time, allocating equal portions to each of the 30 companies because we actually believe in each and every single company that we've actually selected. There's no company that we're trying to prejudice against. So essentially, that's the allocation that we're currently doing. That's what we currently believe in.
And the luck that we have is because it's the stock market. The share you want to buy is not always cheap. So whenever that share is not cheap, and speaking to it depends when you got into Naspers. Right? If it's not cheap, we don't touch it. So it stays in our top 30 because it is the top 30. But because your return is dependent on the price you paid. If it's expensive, we wait. We happily wait. A week like this happens once in 27 years. It happened to happen in our lifetime, and we can get into some shares that we wouldn't have been able to in any of the past 7 to 8 years that we've been doing this. But the important thing is that we were waiting for it.
Okay. So then in terms of sector, if a breakdown of specific sectors that of these 30 companies comprising, is it mining, is it financial services, is it telecoms, what is it?
It's a bit of everything.
I think we just exclude banks and property.
So
because we have a property wing,
literally in every single sector that you can think of, whether it's clothing retail, whether it's mining, plastics, we everywhere, electrical wholesale, literally every single sector that you can think of on the JSE is covered by those 30 companies. So it's a pretty eclectic taste.
And interestingly, if you take the companies, you can actually model your lifestyle from waking up, what you do, if you have a kid, where you're going to take them to eat, what you go throughout the day, the services you use on your computer, happen to fit into the top 30.
Oh, okay. Now that's very interesting. Ladies and gentlemen, I'm certainly learning a lot here, and I hope you guys are learning a lot too. I thoroughly enjoyed our conversation. I don't know if there's anything else you gentlemen wish to share with our viewers there.
From my side, I'd say leave it to the professionals.
Leave it to the professionals.
Get an ETF, leave it to the professionals.
Okay. Yourself?
I'm happy, guys. I think we've covered everything nicely.
Okay.
And
all right. Thank you very much, Millennials. Don't forget to like, subscribe, and share.